Did you know that a well-established investor said that Tesla at its current price is a once-in-a-generation buying opportunity? This may sound cliché now, as a lot of big names have been saying this. It may even appear as a marketing ploy to encourage others to buy Tesla stocks. Stay tuned and keep watching to find out what Barron has to say about this. Investing giants have been divided into fans and critics of the leading EV maker, as Tesla is dubbed today. Ron Barron, a known investing giant, is also famous for being a Tesla bull. In today's video, you will see why Ron Barron said that Tesla stock at this price is a once-in-a-generation buying opportunity. The annualized rate of inflation hit 8.6% in May, the highest in more than 40 years. As a result, the Federal Reserve bumped up its benchmark interest rate by 75 basis points, the largest such hike since 1994. The combination of high inflation and aggressive tightening action by the central bank sent an already jittery stock market to its worst single week since the onset of the COVID crisis, and has economists talking gloomily about a repeat of the late 1970s and early 1980s, when similar inflation and high interest led to market weakness and a deep recession. This is what experts have been warning people about: the threat of inflation and global recession. However, the picture may not be so grim for long-term investors. The broad market downturn drove lower prices across the board, and that can offer up opportunities to buy high-quality names in beaten-down sectors. Billionaire investing legend Ron Barron of Barron Capital sees today's environment as a huge, once-in-a-generation buying opportunity. Delivering Alpha through their Twitter account wrote, "Ron Barron says this is a once-in-a-generation buying opportunity as stocks tumble into bear market." In an email to CNBC, the founder and CEO of Barron Capital wrote, "This is a huge once-in-a-generation buying opportunity." Billionaire investor Ron Barron argued that the recent sell-off in the major U.S. equity indices, which has taken the S&P 500 to its lowest level since late 2020, represents a huge buying opportunity. He said that the recent U.S. stock crash could present Americans with a monstrous opportunity when looking at the economy from a long-term perspective. Barron compared the current situation to early in his career when he founded Barron Capital in 1982. He noted that the early 1980s represented another time when markets crashed in the wake of an aggressive Federal Reserve, which was trying to get inflation under control. He shared that his two sons, who are also investors, now have the same chance he did when he founded Barron Capital, a New York City-based investment management firm known for its long-term investment strategies in 1982 when the Dow Jones Industrial fell to 880 in a bear market. The term bear market is used by Wall Street for when the stock market drops by at least 20% for an extended period, and typically indicates an economic slump. The most recent bear market started on February 19, 2020, and ended just more than 1 month later on March 23rd, according to financial content site Seeking Alpha, and was largely caused by the impact of COVID-19. That bear market lasted for 33 days, making it the shortest the economy has ever experienced, as the stock market bounced back later that year and continued strong throughout 2021. The famed investor argued that today's economy has the backing of a strong tech backbone built up over the past couple of decades, which points the way to significant upside potential over a long-term horizon. Would you buy Tesla stock if you haven't already? Share your thoughts in the comments section below. Barron pointed to names like Tesla as examples of the types of companies that could lead the next wave of tech innovation. The fund manager's comments followed another sharp sell-off on Wall Street. Thursday saw the S&P 500 fall more than 3% and the NASDAQ drop more than 4%, as investors worried that the Fed's rate hiking campaign would trigger an eventual recession. The S&P 500 has now fallen more than 23% in 2022 and closed below 3,700 for the first time since December of 2020. Despite Barron's long-term bullish view, concern about a near-term recession has been growing lately. Overall, we remain optimistic. We normally don't give much thought to short-term macro issues like inflation, oil prices, interest rates, and the Russia-Ukraine conflict. Inflation is always with us, yet most people don't speak of it. In my lifetime, inflation has averaged about 4% to 5% a year. That means approximately double every 14 or 15 years. The stock market doubles roughly every 10 or 12 years, or about 7% to 8% per year. Barron said. Notably, Barron's forecast is about long-term investments rather than day trading and reflects much of the advice the investor has offered about the economic benefits of watching compound interest build up. The key for investors then is to find stocks that are set to gain going forward when the bear runs its course, even if they are down now. Sylvia Jablonski, Chief Investment Officer for Defiance EFTs, shares Barron's sentiments. She said that she felt more optimistic now when it was reported that inflation reached a 40-year high. This is a great generational opportunity. This is going to end up being noise when you look back on it, Jablonski told CNBC Squawk Box. Still, she warns that the next few months would be difficult for investors who are likely to face range-bound volatility. In the short term, it's painful, it feels terrible, and we have to ride it out, she said. Some may wonder, how do people make money on the stock market? Stock markets have been creating wealth for investors for more than a century. $10,000 invested in the stock market 50 years ago could have resulted in a portfolio worth hundreds of thousands, if not millions today. On average, stocks have returned 10.5% per year between 1957 and 1921, although capital appreciation can greatly vary depending on the company. This 10.5% per year is called CAGR, or Compound Annual Growth Rate. Although investing in the stock market has been one of the most effective ways to build wealth over time, there are more approaches to it. Broadly speaking, there are two strategies that investors can use to make money in the market. The first is to buy and hold. The buy and hold strategy has historically resulted in the exponential growth of invested capital. Investors who employ this strategy tend to make money in two ways, including capital appreciation and dividends. Capital appreciation is the difference between the market price of a particular stock or mutual fund and the cost of purchase. Capital appreciation is not taxed until the trade is realized, at which point it is referred to as capital gains. On the other hand, dividends are another key way shareholders are rewarded for buying and holding stocks. Dividends are periodic cash payments that are distributed by companies to shareholders. When a company generates profit, it pays out a percentage of these profits as dividends to shareholders, while the remaining is kept with the company as retained earnings. In addition to the buy and hold strategy, investors can make money by trading equities using leverage and other instruments such as futures and options. Investors can leverage their portfolios to substantially increase the returns on their trades. When investors use leverage, they are essentially borrowing money to increase the gains on invested capital. Futures are contracts to buy or sell a specified quantity of underlying stock at a later date for a price agreed upon. Options come in as a great alternative to futures to potentially limit the downside and risk, as they give the contract holder the right but not the obligation to buy or sell the underlying share, which is in contrast to futures, where both parties of the contract are obliged to buy or sell the stock. Then again, investing is a risk in and of itself. Although there may be countless and unforeseen risks, there are endless possibilities as well. It is important to note that before investing, you should spend enough time and exert exhaustive study on the stocks you are eyeing. Another popular investment technique used by hedge funds and traders to sell shares that the seller does not own is called short selling. Investors who short a stock believe that the stock price is going to be lower in the future. As a result, they would sell the stock today by borrowing it from brokers to buy it back at a lower price shortly. If the price of the stock falls in the future, an investor will make gains by pocketing the difference between the price at which a stock is sold and when it is bought. Tesla, too, comes with both risks and possibilities. For more Tesla stock content, visit our channel and watch our other videos.